The global silver market functions as a critical nervous system for modern industrial civilization. Every major technological advancement from solar energy to high-frequency telecommunication relies on the unique conductive properties of this white metal. Silver prices in the early months of 2026 have entered a phase of unprecedented structural discovery. The market witnessed a historic surge in January 2026 that propelled the asset toward the triple-digit threshold. This rally was driven by a sixth consecutive year of global supply deficits. Total mine production for the current year is projected at 820 million ounces. Industrial fabrication requirements remain elevated despite price sensitivity in the photovoltaic sector. The demand for silver in artificial intelligence infrastructure and data centers is acting as a new floor for valuations. Wall Street analysts are currently fixated on the phenomenon known as the Sunday gap. A Sunday gap occurs when the opening price on Sunday evening differs significantly from the Friday close. In a liquid market, this gap represents a sudden repricing of risk during the weekend break. Institutional fear is peaking because the physical supply in London and New York is reaching critical exhaustion. The COMEX and London Bullion Market Association have reported a steady drain of registered inventories. Central banks in emerging economies have accelerated their de-dollarization initiatives by absorbing available bullion. The geopolitical landscape in the Middle East has added a significant risk premium to all precious metals. Recent conflict escalations have threatened the stability of maritime trade routes. When markets close on Friday, the world does not stop turning. News cycles continue to churn while the official exchanges are dormant. This creates a pressure cooker environment where orders accumulate behind a closed door. The Sunday evening open at 6 p.m. Eastern Time is the moment that pressure is released. Large financial institutions are terrified because they cannot hedge their positions during the weekend. A massive gap upward or downward can bypass stop-loss orders and trigger forced liquidations. In January 2026, silver experienced a single-day move of over 30%. Such volatility is a nightmare for risk management departments at major investment banks. The current ratio between gold and silver has compressed to levels not seen in over a decade. This compression indicates that silver is the primary vehicle for speculative and protective capital. Retail investors have utilized leveraged exchange-traded funds to amplify their exposure. This retail exuberance has created a fragile market structure prone to violent corrections. Professional analysts at Citibank and Deutsche Bank have issued divergent forecasts for the coming months. Some models suggest a return to $150 per ounce, while others warn of a retreat to $85. The uncertainty surrounding the Federal Reserve and its independence has fueled the fire. Inflationary pressures remain persistent despite high interest rates. Silver serves as a dual-purpose asset, being both a commodity and a currency. This duality makes it exceptionally sensitive to changes in the US dollar index. As the dollar fluctuates against a basket of global currencies, silver responds with magnified intensity. The Sunday gap is the ultimate expression of this sensitivity. Traders call it the witching hour for precious metals. Institutional desks are often staffed with skeleton crews on Sunday evenings. This low liquidity environment means that even modest sell orders can cause price cascades. Conversely, a surge in buying can cause an exponential spike in value. The physical metal remains in short supply at local coin shops across the United States. Premiums on silver eagles and bars have risen to 20% over the spot price. This disconnect between the paper market and the physical market is a red flag for analysts. Wall Street is terrified that a massive Sunday gap will reveal a total lack of physical liquidity. If the paper market loses its connection to the physical metal, the entire pricing mechanism could fail. History shows that such dislocations often lead to systemic financial stress. Institutional investors are now tracking social media sentiment as closely as economic data. The speed at which information travels has shortened the reaction time for all market participants. A single headline on a Saturday afternoon can lead to a multi-dollar gap on Sunday. This makes the weekend a period of intense anxiety for those with large, short positions. Bullish investors look at the Sunday gap as a sign of hidden strength. Bearish analysts view it as a symptom of a speculative bubble. The reality lies within the structural deficit that has plagued the industry for years. Silver recycling has increased to over 200 million ounces as high prices attract scrap. However, this secondary supply is not enough to bridge the 67 million ounce gap. Mining projects in Mexico and Morocco are ramping up production, but they face delays. Environmental regulations and water scarcity are limiting the growth of new mines. This means the supply side is inelastic and cannot react quickly to price spikes. The Sunday gap is therefore a reflection of an immovable supply meeting an irresistible demand. The mechanics of the Sunday gap are rooted in the global nature of the silver trade. While the New York and London floors are quiet on Saturday, electronic platforms remain operational. These platforms often have very thin order books, which allows for extreme price movement. Institutional players monitor these movements with a sense of impending dread. The fear is that a major geopolitical event will occur when they are unable to defend their portfolios. In the current climate of 2026, the risk of a black swan event is considered high. Central bank policy is in a state of flux as inflation remains above the 2% target. The European Central Bank and the Swiss National Bank are also struggling with low growth. This global economic stagnation makes silver an attractive alternative for wealth preservation. The Sunday gap is often the first indicator of a shift in global sentiment. If the market opens higher, it suggests that smart money moved into the asset over the weekend. If it opens lower, it can signal a dash for cash to cover margin calls in other sectors. Wall Street firms have spent billions on algorithms to manage these weekend risks, yet even the most sophisticated software cannot predict the actions of a motivated seller. The silver market is relatively small compared to the equity or bond markets. This small size means that a few $billion of inflow can move the needle dramatically. The Sunday gap effectively tests the depth of the market before the big players arrive on Monday. Silver is often called the poor man's gold, but its performance in 2026 has been superior. The industrial demand from the green energy transition is a permanent structural change. Solar panels require highly refined silver paste for their conductive grids. Even though manufacturers are trying to reduce the amount of silver used, the total volume of panels is rising. The Silver Institute has noted that the world is heading for a total shortfall of 800 million ounces over 5 years. This is the equivalent of a full year of global mining output. Institutional analysts are terrified because this deficit is being ignored by the broader market. The Sunday gap is the moment when the market is forced to confront this reality. Traders who are caught on the wrong side of a gap often face devastating losses. A gap that does not fill within the first few hours of trading is known as a breakaway gap. Breakaway gaps are signals of a powerful new trend being established. In February 2026, a series of breakaway gaps led to a 12% weekly gain. This forced many short sellers to buy back their positions at any price. The resulting short squeeze further accelerated the upward movement. Wall Street is terrified that a massive gap will trigger a systemic liquidation event. Major brokerage firms have already started raising margin requirements for silver futures. These higher costs are designed to discourage excessive leverage. However, they also reduce the total number of participants in the market. Lower participation leads to lower liquidity, which in turn leads to larger gaps. It is a self-reinforcing cycle of volatility. Professional wealth managers are advising their clients to hold physical metal rather than paper contracts. This shift in preference is further draining the inventories at the major exchanges. When the Sunday gap occurs, there is often no one willing to sell at the previous Friday price. The bid-ask spread widens to a point where trading becomes nearly impossible. This is the definition of a liquidity trap. Institutional fear is also driven by the memory of the Hunt brothers in 1980. The attempt to corner the silver market back then caused a massive spike followed by a crash. The current dynamics are different because the demand is driven by industry rather than a single family. Yet the psychological scars of that era remain in the minds of veteran traders. The Sunday gap serves as a weekly reminder of how fast things can change. In the United States, the retail demand for silver coins has reached a fever pitch. People are buying silver as a hedge against a devaluing dollar and rising government debt. The U.S. national debt has reached levels that many economists consider unsustainable. This fiscal instability is a primary driver for the precious metals bull market. The Sunday gap is the scoreboard that shows who is winning the battle for sound money. Wall Street is on the defensive because they are largely short the metal to facilitate client orders. If the price gaps up, they must find physical metal to deliver or pay higher prices to close their shorts. The physical market in London is particularly tight, with delivery times extending to weeks. This suggests that the paper price is no longer reflecting the true cost of acquisition. An explosive Sunday gap could be the catalyst for a total revaluation of the asset. The final hour of trading on Friday is often characterized by extreme caution. Traders will often close their positions entirely to avoid the risk of the Sunday gap. This practice is known as flatting for the weekend. When a large percentage of the market goes flat, it leaves the opening hours on Sunday vulnerable. The first trades at 6 p.m. Eastern are usually executed by high-frequency algorithms. These machines search for liquidity where there is none. If a major news event broke on Saturday, the algorithm will gap the price to the next available offer. This can result in a price jump of several dollars in a matter of seconds. The Sunday gap is essentially a vacuum where the normal rules of price discovery do not apply. Wall Street is terrified because these gaps are becoming larger and more frequent. In the 1990s, a gap of 10 cents was considered significant. In 2026, we are seeing gaps of $2 or $3 as a regular occurrence. This indicates a market that is fundamentally broken and searching for a new equilibrium. The role of China in the silver market cannot be overstated. The Shanghai Gold Exchange has become a major hub for physical silver trading. Often the move on Sunday evening is a reaction to what happened in the Asian markets. Because Asia opens several hours before the West, they set the tone for the Sunday gap. Wall Street is essentially playing catch-up to the moves made in Shanghai and Tokyo. This loss of pricing power is a major source of anxiety for US-based financial institutions. The silver market is the canary in the coal mine for the global financial system. It is the most sensitive asset to changes in monetary policy and geopolitical stability. When the Sunday gap is large, it suggests that the foundation of the system is shifting. Institutional analysts are now predicting that the gold to silver ratio will return to its historical mean of 15-1. With gold trading near $4,500, this would imply a silver price of $300. Such a move would be catastrophic for those who are short the metal. The Sunday gap is the mechanism that will likely facilitate this massive repricing. Wall Street is terrified because they are on the wrong side of history. The era of cheap and abundant silver is over. The world is now entering an era of resource scarcity and competition. Silver is the front line of this new economic war. Every Sunday evening is a battle for control over the narrative. The media will often try to explain away a gap as a technical glitch or a minor news reaction. Key insiders know that it is a sign of a deep and growing imbalance. Risk management committees at the major banks are meeting more frequently to discuss silver. They are looking at ways to hedge their exposure using options and other derivatives. But in a market with no liquidity, these hedges can become worthless. The only true hedge is the physical metal itself. And the physical metal is exactly what is disappearing from the vaults. The Sunday gap is the sound of the vault door slamming shut. As we move further into 2026, the frequency of these gaps is expected to increase. The market will eventually reach a point where it does not close the gap at all. This is what is known as a runaway gap, and it signals the final stage of a bull market. Wall Street is terrified of this final stage because it means the end of their control. They have spent decades suppressing the price of silver through the use of paper contracts. But the Sunday gap is proof that the paper market is losing its grip. The physical reality of supply and demand is finally taking over. For the average investor, the Sunday gap is a warning to be prepared. It is a reminder that the markets are not as stable as they appear. The weekend is no longer a time of rest for those in the finance industry. It is a time of vigilance and fear. The Sunday gap is the ghost in the machine that Wall Street cannot exorcise. It is the ultimate expression of market truth in an age of financial illusion. Every week, the tension builds until that 6 p.m. open. And every week, the gap tells us something new about the health of the global economy. The terror on Wall Street is real because the silver market is telling a story they don't want to hear. It is a story of a system reaching its limits. The white metal is shining a light on the cracks in the global financial architecture. And the Sunday gap is where those cracks are most visible. As the sun sets this Sunday, the world will be watching the silver tickers with bated breath. The gap is coming, and with it, a new reality for the global markets.